Welcome back to another episode of Money Script Monday. My name is Kyle Tomko, and today we're going to be talking about how index loans work, how they operate, why it's such a powerful feature, and how we're able to become our own bank inside these contracts, similar to how the wealthy leverage and utilize positive arbitrage. Now, when we take a look at structuring a policy for max efficiency, there's three different stages that we want to look at. However, there's more emphasis on the first two, which is your contribution and your accumulation phase, overfunding up to the non-met guidelines, and earning a decent interest over time during our working years. But that third phase, the distribution, is something that is less concerning for most when it should be up on the forefront. And how are we able to access those dollars in a favorable manner is the question. And I have 5 different ways that we're able to do that inside these contracts. And there's recommended options, there's preferred options, and we'll talk more about why index loans make the most sense. So the first one is a standard loan. Essentially, this is a loan that you're taking out in the first 1 to 10 years, not recommended, where you're essentially paying a 1% net cost. A preferred loan, where you're taking out a loan after year 11, it's a 0% net cost. Now, both of these are very conservative in nature and how to access those dollars, where you can miss some opportunity costs on the back end, and I'll explain why. Withdrawals, now again, you're going to return your cost basis first. This is going to reduce your account values dollar for dollar. So again, we could be losing some opportunity utilizing index loan instead. Full surrender. Now, of course, if you need to walk away from the policy, there could be some tax implications. You could be responsible for paying tax on any interest that you earn inside the contract above the basis. But again, if you need the money, it's there. You can absolutely walk away. And then lastly, index loans. This is where it becomes the most lucrative, where you're able to take out a loan, have that loan be charged a certain percentage, and then have that loan still participate inside the accumulation value, earning that uninterrupted compound interest. And I'll show you an example in a little bit after we talk about the 3 ways that we're able to do this legally, utilizing and taking full advantage of the Internal Revenue Code in 3 different sections. Section 101 is talking about how we're able to transfer our death benefit to our heirs tax-free, free of any income tax. Section 72E is how we're able to grow our assets on a tax-deferred basis. And then Section 7702 is how we're able to access those dollars tax-free. So like I mentioned before, how are we able to be our own bank inside this contract? And we're able to do that through the view of an index loan. But before we do that, how do banks make money? It's very simple. The amount that you deposit to them, they're going to give you a small interest rate. They're then going to loan that money out or leverage those dollars out and charge someone to utilize those dollars. And that difference between what they're giving you and what they're charging someone else is their revenue. So the question is, how can we replicate that? How can we mirror that revenue stream inside our IUL contract? And I have an example here where we're able to show you. So let's just take this example. We have $100,000 built up inside our cash value account, and we want to take out a $10,000 loan. Now again, cash value inside these contracts are tied to an external index, just as the S&P, the PIMCO, the BUDB, the NASDAQ, where we're able to earn up to the cap at 16% in this scenario, and 0 during our down years, such as in 08, and up to the cap, such as 2009, where we're able to do so. But in the long term, in 30, 40 year period, we're averaging about a 6.5 to 7.5% return, assuming these rates. And so to be conservative, for this particular case, we'll assume a 6.5% average rate of return. And so here's how it works. So when we want to access those $10,000, we're going to be charged a loan percentage from the insurance carrier. In this case, it's 5% that's contractually guaranteed, locked in for the life of the contract. We know what it is going to be today. We know what it is going to be in the future. And they're going to charge us 5% on that $10,000. So as you can see here, we have a $10,500 loan balance that is now separate from our policy. Now let's take a look on our accumulation value account, where we have that same $10,000 that we loaned out and are now being charged 5%, but we have that inside our accumulation value where that $10,000 is going to earn that 6.5%. And in the result, that $90,000 is also going to earn that 6.5%. So the money that we loaned out is still participating inside our contracts, where essentially we're able to create that positive arbitrage that I spoke about earlier, where if we're being charged 5% and we're earning 6.5%, we just created a spread in our favor of 1.5%. Now, there are years where we won't earn 6.5%, and there are years where we'll earn more than that. So there's the larger spread can obviously be more beneficial, and so it is more of an aggressive way to access our cash value, but a more lucrative way in long term, as if we're able to average 6.5%. So as you can see here, we're earning 6.5% on both of these accounts. We're being charged 5%. Now that interest that we're being charged can accrue up, and we do have the option of paying that off. But again, one of the benefits of these contracts is not having to worry about paying off that interest that we're being charged. Essentially, again, that's our policy's collateral for that loan balance. So when we do expire in the future, your beneficiaries will collect the net amount after the loan balance is paid off. So again, an index loan, this is how we're able to create our own bank. We talked about the 5 ways to access cash value. We talked about the 3 different sections of the Internal Revenue Code that we're taking full advantage of. And I want you to reach out to your financial advisor and ask them how you can become your own bank and start utilizing this index loan feature. Thanks again for tuning in, and hope to see you next week on Money Script Monday.